also how value investing has really changed. I think back then, if there was a single digit PE and there were some dividend yields, that signaled value. Today, we are looking at 100 plus Ps. What are some of the major shifts that you see that have come in today?
So the 100 P stocks existed even then, and they were not value. You simply have to stay away from a good quality company, but which is overvalued. So late 90s, companies like Infosys and Wipro, absolutely phenomenal companies by the way, but they were trading at 300 times earnings or 200 times earnings kind of multiples. Now, for almost 7 years, 10 years, these companies gave zero return to shareholders who bought at those prices, even though profits grew quite a bit. So essentially, our job is to identify not only good quality managers and companies,
Yeah.
but to buy them at the appropriate valuation. And if things get out of hand, to actually sell them and move on.
But that's such an important point, right? I mean, if somebody sold Infi back then they would be regretting today. So, how do you advise people learn or to develop that patience that sometimes in the long term, it means that you will be sitting on flat to negative returns, but there would be returns maybe in the longer tenure.
So flat to negative returns are a feature of equity investing. It's not a bug.
But over what duration? That's the question.
It can be very, very long. Uh, so at the index level, 1992 to 2003, 11-year period was negative or flat. Uh, Peak 2007, December 2007 to let's say 5.5 years, 2012 or 13, there was a long period
Yeah.
of consolidation. So it can be very, very long. The way to protect oneself against this is to give up some extra returns in the bull period. So if in 2007 you were away from the frothiest sectors, real estate and infra, you would look very, very foolish in 2007, but you did not have such a long period of zero or negative returns because you were away from the frothiest sectors. So if one is okay with reasonable rate of return over a long period, then you avoid the worst mistakes in a bull run.
So, what you said in the previous answer, another question pops up that as a value investor, you have some control over the level at which you're entering. But for those of us who prefer growth companies, how do you decide where to sort of, draw the line? Because growth stories can be exciting, but how do you know you're not overpaying?
Growth companies can also be value investments. So growth is put into your estimate of future cash flows, and based on those future cash flows you arrive at some value you think is reasonable for that company, and then you have to buy it at a discount to that value. So today in our portfolio we have companies like Microsoft, Google, Amazon, Facebook, which a lot of people would classify them as growth companies, but we think that they are intrinsically worth more than what they are quoted at in the market. So it's not that we are against growth, it's just that we are against overpaying for growth. There's a fine line, a
I would
distinction
love for you
between these.
to, elaborate because I think you have said that predicting